Real estate or the stock market? Which one actually makes you more money? If you ask the internet, everyone has an opinion, but almost nobody actually runs the math. Today, we're going to look at the exact numbers over 20 years, and the winner might actually shock you. Let's meet Jake and Marcus. They are both the same age, they both make the same salary, and they both have exactly $50,000 saved up. The only difference is what they do with that money. Jake takes his $50,000 and uses it as a 20% down payment on a $250,000 rental property. He finds a tenant, the rent covers the mortgage, and on paper, he's making a clean profit every month. Jake feels like a genius. He has a physical asset he can look at and brag about. Marcus takes a completely different path. He takes his $50,000 and puts it straight into a diversified mutual fund. On top of that, he sets up an automatic SIP, a systematic investment plan, of just $300 a month. He doesn't buy a house. He doesn't deal with tenants. He just lets the SIP run in the background. For the first few years, Jake looks like the clear winner. He gets a rent check every single month. Marcus just logs into his app, sees his balance go up a little, down a little, and up a little more. It's boring. Nobody is impressed at dinner parties. Let's jump ahead to year 3. Jake realizes that the rent check isn't pure profit. He has to pay property taxes, he has to pay for insurance, he had to replace a broken water heater, fix a leaking roof, and deal with a tenant moving out, which left the house empty for a month. When you subtract all those hidden costs, Jake's actual cash profit is just a fraction of what he expected. And that doesn't even count the weekends he spent fixing things. Marcus, on the other hand, hasn't spent a single second working. His initial $50,000 plus his monthly SIP contributions have been quietly compounding. His money is making money. Now, let's fast forward 20 years. This is where the math gets crazy. Jake's property went up in value. It's now worth around $500,000. He paid down his mortgage, and he has built some serious equity. Real estate gave him leverage. He used the bank's money to grow his wealth. But what about Marcus? After 20 years of a simple, boring $300 monthly SIP, Marcus's portfolio has exploded to roughly $450,000, and he has zero debt, no tenants, no broken pipes at 2 a.m. They both ended up with a massive amount of wealth, but how they got there was totally different. Jake worked a part-time job as a landlord for 2 decades. Marcus just waited. And here is the ultimate twist. If Marcus had increased his SIP by just $200 more a month, his portfolio would have crushed Jake's real estate returns by a mile. That is the magic of compound interest. Does this mean real estate is bad? Not at all. Real estate builds massive wealth through leverage and tax breaks, but it is a business, not a passive investment. Stocks and mutual funds are truly passive, but you have to have the iron discipline to keep your SIP running even when the market crashes. The biggest trap isn't choosing stocks or choosing real estate. The biggest trap is making a massive financial decision without doing the math for yourself. So, which path are you taking? Let me know in the comments, and don't forget to subscribe for more real financial logic.